I want to bring in Lara Rhame, who's joining Chief U.S. Economist at FS Investments on the phone. Lara, so right now we've been hearing the case over and over that this is the worst financial crisis and economic situation since '08. Is that the way you're viewing it at your firm as well?
Yes, I think in terms of the headline numbers, the volatility, the implied volatility that we're seeing, and the severity, the violence of this downturn, I think feels very similar to '08. Of course, the cause is very different. And for that reason, we are probably going to need to address this with tools that aren't pulled directly from the prior playbook. Be clear, those will help, but going ahead, we're going to want to think of different ways to solve these economic problems that we're going to be facing this coming year.
What's interesting is this is a very proactive approach. At least that's the way I've described it. Do you agree with that? I know that there's this argument to be made that the U.S. on the actual virus side has been slow moving, but in terms of deploying these tools from the monetary side specifically, this is very much getting ahead, basically trying to, it seems, prevent a recession that we assume is either already upon us. Has there been something like that in the past? From what I understand in my history books, it's mostly reacting.
Yes. So, two very different sides of that. The Fed has sprung into action very quickly, and that is clearly a lesson learned from the prior downturn. And it is also clearly pulling directly from that prior playbook. So the good news there is they had some of these pipelines to push liquidity directly into markets already built. So there we're able to see much quicker action. And on the fiscal side, to some degree as well, we're seeing policymakers, I think, reach for things which are really obvious low-hanging fruit. Extending unemployment benefits is a really good way to try to mitigate the economic damage should layoffs become really intense, which I think, unfortunately, we are probably going to see. And I think, again, feeding money directly to households is something that we did in 2001. It was relatively effective, not at reversing a downturn, but again, trying to just mitigate the damage or mitigate that contraction. But clearly a different scenario this time around because, I think it's a rare question to ask what good it does to push money to households if they can't immediately go out and spend it. So, different from 2001 when stores were still open, restaurants were still open, people were scared, different profile right now. So again, we may not be able to just copy what we did last time around. Yeah,
it's interesting, right? Where are they going to spend it? You can only have so many different content subscriptions, and believe me, there are a lot. But, I think this brings up another interesting point, Lara, as we were talking with Nick Colas earlier on the show from DataTrek. One way I can think of kind of to describe it is we know there's this chasm coming and we're kind of like building this ladder to lay down as we're running towards it. And it's almost this kind of weird timing thing now because if we get there and the ladder is indeed built, let's say we have support for businesses that are having to shut doors. A lot of folks can work from home, so they're not going to get laid off, but many cannot, and many of those stores are closing, and there might be deep ramifications. But let's say by the time we get to that chasm, if we have overestimated its depth or we already have the tools to deal with it on the fiscal side, then what happens when we then have a bunch of monetary involvement as well? I mean, I know it seems like heresy to ask us this at this point, but I think we need to in this conversation, which is, what if it's too much? What if we didn't need both? What if the fiscal is going to be able to build a ladder for us, and then all of a sudden we're on fire because all this money has been injected into the market?
So, that's I think, a valid distinction between what we're getting from monetary policy and what we're getting from fiscal policy. And I think you could turn that around and ask the question, how much is Fed stimulus actually going to reach the underlying economy? To me, Fed action right now is really just built at trying to put a floor under financial markets and trying to calm this dreadful volatility that we're all experiencing. The fiscal side is absolutely what we're going to need to help the economy. And I think, the government is looking at this in the same way that the CDC is talking about the virus. Better to be blamed after the fact for being too proactive than to risk not doing enough and worrying about that much deeper downside vulnerability.
When we think about then the efficacy, basically as you're describing, they don't want to get caught not doing enough. But then as we look at the Fed after, of course, a decade basically of moving to compress the business cycle, right? We kind of started this conversation about how the Fed used to react, or in some cases even cause recession and hike our way through inflation and whatnot. Now they've gone from kind of keeping that business cycle in line to basically trying to prevent recession. Are we going to find out that there are downsides to that? Are we going to find out that the Fed looks very different on the other side, that central banks will come out of this scarred?
Well, I would argue that they have been scarred since the global financial crisis. I mean, we've seen all of the big three central banks just adding to their balance sheet. That process has never stopped since the global financial crisis. Probably one of the biggest questions I get asked by investors and by clients is, when does this end, right? We get zero interest rates. We get the Fed pushing liquidity in, all these central banks pushing liquidity in. The economies remain relatively stagnant. Yields remain relatively low. I think it went from investors feeling like, okay, liquidity is a good thing. We get the equity returns, to investors now saying, well, if we don't get the equity returns, and the income side is now so badly challenged and is suffering also terrible volatility, where's the safe haven? What path have these policies led us towards? And I think it's going to be a reckoning that we're probably going to be dealing with for the next decade with central banks. I think it's too bad they didn't address it over the prior decade. Again, when you don't address problems when the economy is good, boy, it sure is virtually impossible to address them when the economy is challenged.
So now if we connect this back, I think these are really good points, Laura, if we connect this back to investment strategy, what does it mean at your firm? Does it mean that we should heed some of the messages from the gold bugs and such, that this is going to be a downturn, but a fast one, that then we have to deal with inflation on the other side? Do we ignore that because deflation is the more obvious, imminent coronavirus-driven risk? What does that mean in terms of where you want to put your money right now?
To me, inflation is not at the top of the watch list right now. Right. I'm really focused on investments that have, we need to get these investments in place that have steady returns, that are true diversifiers. From our point of view, we're largely a fixed income shop. We've got the equity products that we've got are very geared towards trying to offset this volatility. And I think for fixed income, it's never the new crisis or the new challenged market is never what the old one was. I think high yield is a great place to be. And when you look at how high yield responds in downturns, it's got a way better Sharpe ratio than equities do. It's the place that a lot of people have been concerned about. And right now, it's not the place where you're seeing the most acute stress. You're seeing it in, munis, in treasuries. It never comes from where you think. But, products that can deliver you a steady return, anything that is, a good, real return, I think is where you need to be, because let's face it, no matter what interest rates do, they're going to stay low. There could be that volatility overlaid on it, and we've had some backup in yields today, given the fact that people are starting to cue in on the massive deficits. But we're definitely in for a low yield environment, especially the core fixed income space.
The last point there then, because right now today's move coming into the market, we've seen bonds bounce back actually pretty solidly here over the last hour. But to your point, there's now going to be funding from the sale of bonds, of course, to get the fiscal rescue package. There was already some selling, though, in euro bonds, Laura, even after Christine Lagarde waxed a bit hawkish. So it's been interesting to watch this huge amount of volatility in treasuries. It seems our definition for low rates, we got pretty close there to like 50 basis points at one point. So does low rates mean we could still sell off? How do you as a fixed income shop basically gauge the new regime of volatility the treasuries are in?
Well, and thankfully, we're not playing in the treasury space. We're more company focused. We're more active managers. But I think it speaks to the fact that you can't just plug and chug into the Barclays Ag like you used to be able to. Last week, Barclays Ag sold off over 3%. That was the worst sell-off since 1980. People are focused on the volatility in equity markets, but it is coming at investors from every angle.
Yeah, Lara Rhame, really good stuff. Appreciate you joining us here.
Thank you.
Really important insight on a day with plenty of volatility. S&Ps haven't really done much in the last 60 minutes, but bonds have indeed bounced back. We still are yet to figure out what that really means as correlations continue to break down from the textbook relationships.